Welcome back to the Talking Hedge. I'm Josh Kincaid, Capital Markets Analyst and host of your Cannabis Business Podcast. Today, we're going to take a look at an article to see if this is the worst possible time to raise capital, look at some stock gainers and winners, as well as looking at to see if cannabis is positioned to weather the storm. So Jim Macoso, he's the founder of Lucid Labs. He was recently interviewed by Ben Zinga asking about the current market debacle and carnage on Wall Street. Jim told Benzinga that the U.S. cannabis sales in 2020 will pare back from previous years, but not quite as bad as the rest of the consumer-based market. He goes on to say that cannabis is akin to other consumer staples and vices like beer and wine, which tend to outperform other areas of the market during times of financial difficulty. However, startups that were in fundraising mode or in need of loans will be in dire straits as funding freezes. The recession that started in 2008 is that consumer staples and consumer vices seem to outperform other areas of the market. As it turns out, people were still buying beer, wine, toilet paper, soap, and toothpaste, albeit less frequently with higher sensitivity to price. Jim anticipates a similar trend in the cannabis sector, with consumers likely to buy products that are priced at the lower end of the market while purchasing less frequently. In 2020, he expects the U.S. cannabis sales to pare back from previous years and also anticipate that investors are going to pause on new investments into the sector as they shore up capital reserves until there's more stability in the overall market. This is given the recent drop in U.S. equity markets more than 30%, so a lot of investors are a bit hesitant to take on a new risky investment, of which the cannabis sector seems to be at the top. So with respects to projects that have already been funded or are already under construction, Jim is anticipating those projects to continue with a higher focus on remaining on budget and potentially slightly under the time due to the recent workforce in many places. The volatility is pretty fierce. You can see some of the gainers are now losers and the losers are now gainers. So I would expect to see a lot of that. In fact, if you take a look at the most highly sold shares that have the highest negative return, the next day they're probably going to be positive. So there's a lot of volatility flipping back and forth. You can see that just right here with a 7% pop on Origin Architect. Now they're down 3.3%. Heritage Cannabis is down 12% after being up 3.4. Hexo is up 6% after being down 16%. That's a penny stock though, so it's pretty easy to do that. Cureleaf is up 3% after being down 11. So just playing those bounces back and forth during times of volatility can be pretty profitable for a trader. So although you've heard a lot about recession proof and sin stocks, vice stocks being better than the overall market, there's still a long way to go down. So we're going to kind of highlight how this is just a temporary pickup, a false breakout, a dead cat bounce, whatever you want to call it. This is just a recovery that's going to be short before another crash. So we saw a lot of those in every downturn, 1933 or 2008. You'll kind of see it go down a little bit, come back up, but we're not at the bottom yet. So how long do we have to go to the bottom? Well, in summary, the stock market's completed a first phase of a bear market with a rapid and sharp first quarter sell-off caused by massive deleveraging. So stocks are going to need to deal with a valuation problem as well as discounting the long-term financial and economic impact of the coronavirus shock, i.e. the supply chain disruption. When people like Boeing or Tesla can't get parts and then they can't make them, not because they're at home anymore, but because they just can't get the part, that's going to be another issue. So even with a 25% sell-off since February 19th's high, the stock market capitalization to GDP remains extremely elevated, still higher than its pre-Great Financial Crisis high, and at the 85th valuation percentile, meaning it's 85% over the normal. So the analysis is illustrating that stocks still have a 40 to 56% downside to reach the valuation levels where the past two major bear markets bottomed out at. So time rather than price could bring valuations back into line with historical valuation levels as stocks settle in for a protracted bear market. So that's intrinsic value or hysteresis. That's the phenomenon in which the value of a physical property lags behind the changes in the effects causing it. So there's a total lost confidence in the dollar as the world's reserve currency could spark inflation and boost stocks at an inflation hedge. So this is also known as a Buffett indicator. You're looking at a total market capitalization of all U.S. stocks relative to the country's gross domestic product or GDP, what they make. In the U.S., we don't make much. It's pretty low, 3%. This year, they're looking at maybe negative 15%, which is brutal for pensions that need 7% just to break even. But when it's in the 70 to 80% range, it's time to go. So it moves well above 100%. It's time to tap the brakes here at all-time historic highs. So first, GDP is more difficult to manipulate than earnings, which is subject to accounting. Um, Second, stock valuations can be divorced from the economy. Earnings should theoretically track long-term economic trends. So stocks are still overvalued at today's close. Stock market remains extremely overvalued, even with a generous assumption that first quarter nominal GDP contracted 1.4%, which is not going to happen. But the market cap to GDP finished the quarter at 119% to GDP, which is still 9 points higher than its peak at the end of the second quarter 2007, just before the great financial crisis began. So you can see at the percentile ranking at 84.9%, not seen since 1974, the year that the Wilshire 5000 total market index was created. The 2007 to 2009 great financial crisis bear market bottomed out at a market cap of 56.36% to GDP. So the first scenario assumes a GDP decline by an annual rate of 12.7% for the first half of 2020. And the second scenario assumes that the nominal GDP is at the end of the 2019 levels, which is very generous and not likely. Both show that the stock market has a long way to go down until it reaches the value zone, a downside range of 40 to 55% lower, or S&P equivalent to 1123. So I think this is also taken into account when the shit hits the fan with a lot of the other bubbles, the auto industry, now the airline industry, hotels, you have student loans. There's a lot of issues out there. So if helicopter money comes out and starts paying off all of these things and all of these bubbles pop, then housing could come down too. So if they have to bail out housing, then you're also seeing an overvaluation from historical norms, or the median average needs to drop 85% from the all-time highs. So this stock market could drop another 50%. Housing could see a drop in 85%. And that's total worst case scenarios. You might see that in certain regions or globally, and then the whole political theater behind that. Maybe they're going to ban real estate investment trusts on the residential side as a national security to housing, so that prices can't get out of whack like that with speculation. Who knows? Don't know if it'll happen, when it'll happen, or how it'll happen, but we will report on it. So you have to come back to the Talking Hedge and find out. So with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out.